This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gordon Long with GordonTLong.com, and I have with me this morning John Rubino. John is the publisher of the website DollarCollapse.com. We will continue from session 1, already in progress. Another one you had was debt jubilee.
This is a fascinating idea that is harder to refute the more you dig into it. There's an Australian economist named Steve Keen who has, among other people, but he's the public face of it right now, has come up with the idea that we should have quantitative easing for individuals in which the government creates a lot of new dollars, and instead of giving it to the big banks so they can build up their balance sheet, gives it directly to people in order for people to pay off their debts. In other words, let's say you have a mortgage, the government gives you $500,000 and tells you to go out and pay off your mortgage. You become debt-free. The bank gets cash in return for the mortgage that it had written to you. And so the systemic leverage goes down to the extent that the new money is created and used to pay off debt. And the idea behind this is that we're at kind of an event horizon for debt right now where we've borrowed so much that we can never get out of it. It's just going to have a gravitational pull on us that keeps us in a depression for as long as we maintain this level of debt. And the only way to get out of it is to get rid of the debt somehow. Now, historically, that's happened through either hyperinflation or through a collapse like in the 1930s. Those would be incredibly painful processes to go through. And the idea behind a debt jubilee is that maybe this is less painful. And one variation of this is that the Fed, which is buying a huge amount of government debt right now, could just wipe that debt out, just cancel it. And so with a stroke of a pen, the U.S. national debt goes down by several $1 trillion, which would improve our balance sheet. And, if we're being profligate, allow us to keep borrowing. And if we're being reasonable, allow us to set up the conditions for a lower debt society going forward. Now, because this sounds painless, it's probably going to get a lot of press going forward. It's going to appeal to people who don't like the other alternatives. And so it'll be interesting to see how this plays out. I assume there are a lot of downsides to this, which I don't really understand yet, but I haven't yet seen them. And because they're not immediately obvious, it's going to appeal to the people who are terrified of these alternatives. So we'll probably see the debt jubilee become, if not front page news, something that's discussed more widely in the coming year.
Roosevelt said back in the 30s, nothing in government happens by coincidence. And that is, in this example, if you're hearing this and it's leaked and being discussed, it's not by coincidence. These are trial balloons that are being put out there. And what it would do to the private holdings of bonds is a real question. If it was a single country, it would be devastating. But if the countries did it in a coordinated fashion, and you've heard me talk about this currency cartel, John, of all of the people that actually effectively hold the four currencies of the reserves, if they did it together in some kind of equitable fashion, it's a possibility. And when you've got a possibility in front of politicians that's an easy way out, you can assure it's going to get airtime.
Oh, yeah. The idea that I'm going to print a bunch of money and give it to you and you're going to pay off your mortgage, that is just candy. That's a candy store for politicians because you're giving stuff to people with newly created money. That's paradise.
When we have a crisis and it's looming, these kinds of things will become not just possibilities, strong considerations in desperation as people are clinging to anything. And then there's going to be politicians who will put these on the table as viable alternatives. Always the way. Just your last one you had I thought was particularly interesting, the end of the petrodollar.
This is one that is very timely because Well, to set this up, back in the 1970s, we cut a deal with Saudi Arabia and the rest of OPEC, under which the U.S. would protect these guys, keep them in power, in return for them accepting only dollars in return for their oil. And that had the effect of making the dollar the world's reserve currency. Everybody in the world needs dollars now if they want to buy oil. And that allowed us to do all the things that we've talked about already, just borrow unlimited amounts of money and create all this debt. And it also gave us the ability to fund a military that is basically untouchable. We're so much bigger and more powerful than China and Russia and anybody else you want to name because we have the dollar. We can borrow as much money and create as much new currency as we want to fund a global military empire. That's a painful system to live within for a lot of other countries. And so the process is beginning now of other countries starting to chip away at the status of the petrodollar. China and Russia and to an extent Japan are starting to trade oil and other commodities in their own currencies. So they don't need dollars anymore. And as that spreads, that's going to decrease the need for dollars out there in the world and cause a lot of central banks and other big trading powers to sell the dollars that they've been keeping because they felt like they needed to have 70% of their currency reserves in dollars and drop that down to 50 or 40 or 30%, which means a lot of selling pressure around the world on the dollar, which means higher prices within the U.S., which means possibly the kind of death spiral that we've talked about before, where our interest rates go up because the world won't let us borrow money at low interest rates anymore. And that causes our interest costs to go up, which causes our budget deficit to go up, which causes us to need to borrow more, which hurts the value of the dollar even more, ad infinitum. Until the dollar goes into kind of a death spiral, and we have the currency crisis that you would expect just looking at the debt numbers that we've been putting up. So the end of the petrodollar could be the end of the fiat currency empire around the world. So this is a very interesting thing to watch, and it could come to a head in 2013.
It certainly surprised me how long it's been sustained. And I think what might trigger it is the Iran putting in its new bourse and now opening them where it will be selling its oil in any currency, including the U.S. dollar. They start to transact in a significant way. Russia's already willing to do it as an oil exporter. It's going to dramatically shift the balance of power in regards to the U.S. dollar and these reserves that have to be held up. I expect the United States to take some kind of action before that happens, John, regarding specific to Iran being able to do that. How it contains it, whether expanded sanctions, I'm not exactly sure, but we will see that unfold. But we're nearing the end of the petrodollar because the United States is not the industrial export country that it once was, trading partner, so therefore there's not the same need for trade with the dollar. There's, ever mind the U.S. dollar, the need for exchanging it. I think we'll see ourselves down 52%, 55% of the world's reserve currencies being in U.S. dollars. And as you said earlier, that's down from 72% in 1999. So yes, there's more dollars, but as a percentage, it's only now that it's really starting, those percentages are starting to accelerate.
That really presents the U.S. with a tough decision going forward, because do we let it happen, as it inevitably will, if the numbers play out as they are now? Or do we try to stop it by, like you said, intervening in some way in Iran? Is that where the false flag comes from? Do we accuse Iran of attacking us in some way in order to give us an excuse to go in and stop them from threatening the petrodollar? And does it happen in 2013? These things seem to be coming to a head pretty dramatically and pretty quickly. So it's very possible that we see something like this happen in the next year. Either we make the decision to let the dollar lose its reserve status, or we try to stop it through some kind of military action. And it could be a cyber attack, like we've been talking about. It could be overtly military. It could be some involvement with Israel based on Iran's nuke program. There's all kinds of possibilities, and every single one of them should be terrifying from the standpoint of a money manager. If you've got a big bond portfolio, this is your nightmare scenario right here.
Yeah, exactly. Any other thoughts in 2013? Not just of themes, but as investors and what they should be concerned about, or Or what are you looking at from an investment standpoint in 2013?
It feels to me like we've made a lot of crucial decisions towards the end of 2012 that really clarify the picture for us. Now, every major central bank is now in massive easing mode, and that inevitably has to lead to higher asset prices because remember, these printing presses are basically unlimited. If $10 trillion didn't do it this year, then $20 trillion will do it next year. And if that doesn't work, they'll up the ante. So these guys are really all in right now. And that means that the ongoing attempts to depress the price of gold and silver will inevitably fail at some point because the imbalances will just become too immense and too visible. So I think next year should be great for precious metals in particular and hard assets in general. And so if you're an investor and you're trying to decide what to do with your money right now, and you've got a lot of bonds, for instance, congratulations, you've done really well with that bond portfolio. But now is probably the time to shift out of things that pay you a steady stream of some paper currency and into things that can't be created in infinite quantities by governments on a printing press.
John, that was starting to happen. Money managers starting to do that. But recently with silver and gold getting absolutely crushed regularly out of nowhere, mysteriously has frightened them. And I've heard it from more than a few sources that have said, I don't want to be in that kind of game, even though it looks like it's a rigged game. It goes right back to when we started hearing tungsten was embedded in the gold, and people said, well, how am I going to make sure my gold is assayed? So they've put enough fear in there. They believe they can delay it. But I've heard money managers who believe this is a way to go, frightened to enter this kind of marketplace. Something I hadn't heard 6 months ago.
Fundamentals always win out in the end. And you're right that there's a lot of behind-the-scenes manipulation going on. One of the things that's interesting about precious metals is that they just get whacked every once in a while. At some point when the market's kind of thin, you see a lot of selling come in and the price just craters.
Oh, John, it's predictable. Off hours, Asian markets, low volumes, and all of a sudden somebody selling huge amounts, which makes no sense unless you're just simply wanting to drive the price down.
Yeah, exactly. If you're a hedge fund and you're trying to get out of a position, that's not how you do it. You wait till the market is liquid and strong, and then you sell into that. You don't wait till 4 o'clock in the morning and then smash it down because you get a much worse price on your second and third sales as you do on your first.
Once in a while, we could say maybe it was a fat finger or something weird, but this is consistent.
No,
consistent all the time.
And so what that is governments trying to make it painful for people to speculate in precious metals.
Precisely.
And it works. You've got a lot of really frustrated gold and silver owners out there right now.
Well, you also have a lot of very frustrated money managers and fund managers who are terrified of their bond portfolios suddenly losing tremendous amounts of money to believe that the risks are too elevated in the stock market but have to be fully invested. They seriously see this as an alternative, but they're saying this is even a higher risk proposition because I believe and I can see it to be potentially manipulated or easily manipulated.
Yeah. Talk about our healthcare costs going forward. I think the money management community is going to be a big user of of heart-related and stress-related drugs and things because life is very hard if you have to be fully invested, as you said, because nothing really looks good right now, and they haven't behaved the way they should have behaved going in the past few years. A bond portfolio, which a lot of money managers have to own, they have to have a certain amount of their money in fixed income, has performed really well, but at the cost of constant stress. You never know when your bond portfolio is going to blow up. And yet you have to be there with a certain amount of fixed income. And someday it's going to just crush you. and that day I think is coming. And money managers know this. They see the same numbers you and I see.
Well, they know it. And they usually have cash at a certain level for redemptions, and even the cash levels are at all-time lows because they've got to squeeze just that much more yield out because it's getting harder and harder to get yield. So they're all more and more frightened and worried. This is financial repression working very well, forcing them into higher and higher risk assets and in a very clear kind of direction, but certainly limiting those who would flee to gold and silver and other kinds of hard assets.
Yeah, you're right. And that is the other thing about a lot of money managers now. They have a certain yield target. They've got to make 8% if they're running a pension fund portfolio. And the only way to do that with your fixed income segment is to go way out on the risk spectrum and load up on developing country bonds and U.S. junk bonds and things like that, which are going to behave like equities. In other words, they can drop by 20 or 30% in a week in a market correction. But you know that, you know that that's what you're setting yourself up for, but you have no choice. And so to live with that risk has got to be pretty tough.
I asked a friend of mine, I said, how do you live with these? I wear a parachute to work every day. So, so they know it's coming. They just hope that they've got their parachute on. But remember, it's easy to take risk with other people's money, John.
Well, that's true. You save your year-end bonuses year after year, and while your bond portfolio goes up, you make a lot of money. And then, if you end up losing 30% next year and you get fired, at least you leave with the bonuses that you saved. So you don't suffer the way the lower-level employees of your firm are going to suffer if things fall apart.
And those who put the money into those funds called the public. The old poker game, when you look around the table and you can't figure out who the dupe is, who the patsy is because it's you. And so the patsy at the table here is the public who doesn't know what's going on and are just ready to be fleeced when this happens because it's going to happen. They know it's going to happen. They just don't know quite when. One of the things about a market is never try to time it. It's going to happen, whether it's 6 months, a year, 2 years. That shouldn't be important to you. You should be able to sit and make a decision because you can make all this money every day and think you're doing really well, but I guarantee you won't get it out. And when it drops, you'll lose. Consistently, what happens is you lose a year or 2 years worth of what you perceive to be profit disappears in 2 or 3 days. When the markets adjust, it's that quick, and you can't even, your stops a lot of times don't even get filled. So you get lulled into it, and you think you're fine. And it's like the old guy who's told that the crime rate in Southside of Chicago is that if he goes out of his house, the chances are that 90% of the time he's going to get mugged. So he goes outside his house, goes for a walk, doesn't get mugged, comes home and says, hey, it's fine. He goes out the next day, same thing, nothing happens. He goes out 5 days, hey, what's the problem? So he thinks there's no risk around here. Now just think, what is the probability of him being mugged the next day, right, John? And so what happens is we get lulled. And so the risk is actually getting higher and higher and greater statistically from a probability. But we get lulled into it because of complacency. And right now we have the highest level of uncertainty we've ever seen and the highest level of complacency. That is a bad cocktail mix. But I've seen it before. I saw it in 1987. I saw it in the fall of 1999. I've seen it other times, maybe not as dramatic, and it's the same story. The other thing I've learned, John, it goes on longer than you think it's going to go on. You think it's about to happen, and it just drags on and on until you feel like you cannot not be in the market, or you're losing too much money, and as you get in, that's when it suddenly crushes. And it's like it brings in every single cent before it finally crushes, almost like the housing bubble. Everybody had to be in a house and multiple houses. If you didn't buy, you were never going to get on board till we got so high and so elevated, and then it happened pretty quickly, didn't it?
Yeah. And now we're there with government bonds. Everybody in the world owns treasuries out there. And they've fallen to yield levels that, if back in 1980, you and I were talking about this, and I said, the U.S. will be borrowing $1 trillion a year, but long-term bond yields will be 2 or 3%. You just said that's insane. That's physically impossible.
Right.
But we've gotten there. Somehow we got to this point. And the way bubbles work is you get to a point where it seems crazy. It can't go on, and it goes on for a while longer. It gets even crazier. And then just when you think, well, okay, maybe this is the new reality, then it blows up. And I think we're near that point in government bonds, but who knows? Maybe we could have a couple of more years of this. I don't think we will, though.
What happens is everybody looks at each other and says, this is crazy, but it keeps on going. So finally they all shrug their shoulders and say, what can you do about it? And so you join the party. And then that's when all hell breaks loose. And and that's why you have these wedge formations, what they call ending diagonals in technical analysis. I know Charles Hugh Smith done a lot of work where he takes these wedge patterns into the social attitude and bureaucracies and how things break. And it's really psychological of how we accept uncertainty and we become complacent with it, but not understanding risk. It's a classic. We're in it. It's happening. But how long it'll go on, I don't know. But it's not important. For the average person, that shouldn't be important. It should be enough to say this is too high a risk, a time to be playing this kind of game. And there's other ways to, there's other investments that are out there. Investments that maybe don't involve financial securities. I talked previously about owning farmland. That was the kinds of things now people talk about it, but 10 years ago, nobody talked about it. There are many investments out there that are unencumbered and will give a good return even in very troubled times. A lot of people made a lot of money during the Depression, John, but it's not typically in what everybody's doing. And right now, everybody believes you have to make money in the securities marketplace. Right now, at this point in time, for the next 12 months, question that personally. John, we're way past our hard line, but great conversation. Any last comment we'd like to make?
No, I've kept you on longer than I should have anyhow, Gordon. This was fun, though. This is a fascinating subject, and, let's do it again.
John, could you tell our listeners how they could learn more about the kinds of things you do, your website, and how they could get a hold of you?
Yeah, I run dollarcollapse.com, which on a continuously updated basis covers the stuff we've talked about here. And I expect we'll have a lot of interesting stuff to say in 2013.
I'm looking forward to it. It's been a great year. I thank you very much for the tapes that we've done. They've been very, very, very well received. And just outlining these kinds of concepts here for 2013 says we're going to have a lot of fun here in the next few months.
Great. Thanks.
Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.